Welcome to the third and final installment in our tariff series. Tariffs are back in the news, and if history has taught us anything, it's that they can shake up the economy and markets in unexpected ways. But before we panic and start stuffing cash under our mattresses, let's take a step back and break all this down logically. Today we'll do a quick review of what we've covered in our tariff series videos so far. What tariffs are, why they're used, and how they can help or hurt the economy. Then we'll discuss what's going on today and what they can mean for your investments. Let's get started. So what are tariffs and why do they exist? Tariffs are taxes on imported goods. Governments can use them to protect domestic industries, generate revenue, or correct trade imbalances. In theory, tariffs encourage production by making foreign goods more expensive. But there's a catch. While they can help certain industries, they can also raise costs for businesses and consumers and disrupt supply chains and trigger retaliatory tariffs from other countries. So the real impact of tariffs depends on how they're applied and how companies adapt. So who wins and who loses? And how do tariffs affect different industries? Not all companies are affected by tariffs in the same way. Some stand to gain while others can take a hit. Let's break it down for you a little bit. Retailers that rely on Chinese imports like discount stores could struggle. As tariffs drive up costs, it could squeeze their profits. Meanwhile, retailers with diversified supply chains or domestic sourcing, like home improvement chains, they may be better positioned. Think of it like this. A dollar store that gets most of its products from China may be in trouble, while a home improvement retailer that sources from multiple countries across the world or even domestically, they may have a little bit more flexibility. Another example would be something like regional banks and auto manufacturers. Regional banks may be less impacted by tariffs compared to industries with direct supply chain exposure like auto manufacturers. Many auto manufacturers rely on parts and production in Mexico and Canada, so tariffs could increase their costs and create supply chain disruptions. But here's an interesting angle. If tariffs actually make it easier for US businesses to compete, regional banks might benefit from increased lending activity as small and mid-sized domestic businesses look to expand their operations. These are just a few examples, but remember, things don't always play out the way we expect. Businesses and markets have a way of adapting, and the long-term impact of tariffs depends on how companies adjust to new trade policies. So what's going on right now? Now that we're all caught up, let's talk about that a little bit. Unlike the slower rollout of tariffs during the 2018 and 2020 trade war, the Trump 2.0 administration has wasted no time. New tariffs on Mexico, Canada, and China were implemented right after Inauguration Day. There are more tariffs planned for April, and they're expected to be reciprocal in nature, meaning they'll counter existing trade restrictions from other countries. And the market's reaction? The speed and severity of these tariffs have already spooked the markets, particularly growth stocks, as you may have already noticed. The Federal Reserve stance has changed a bit. Back in 2018, the Fed was raising interest rates. Now they're taking a more neutral stance at the moment, but they're willing to cut rates if economic data calls for it. So what lessons can we learn from the last tariff showdown? We've seen this movie before. During the last round of tariffs, the S&P 500 dropped more than 17% at its lowest point. But here's the key takeaway. I want you all to remember this. Despite the volatility, the S&P 500 still ended up over 20% higher during this almost 2-year period. And those tariffs, most of them are still in place today. Businesses adapted, supply chain shifted, and life moved on. This is why trying to time the market based on tariff news can be riskier than simply staying invested. Let's zoom out for a second. I think there's more going on here than just tariffs. The administration has a narrow window to push its agenda before midterm elections come up. So they're acting fast while they have full control over Washington. Once election season kicks in, things are going to get trickier. Then there's the dirty D word, debt. The federal government has about $9 trillion in debt maturing this year. That's about 33% of all outstanding government debt. One of their goals? Lower the 10-year Treasury yield to make refinancing that debt cheaper to refinance at longer terms. The federal government wants to stop this cycle of refinancing debt for short durations that's been on for the last few years. but the Fed has made it clear that they aren't in a rush to lower rates. So how do you push rates down? Economic uncertainty. Historically, when markets are uncertain, investors sell stocks and buy bonds, which lower yields. If tariffs create uncertainty, we could see a flight to safety into bonds, helping bring Treasury yields down, making refinancing that debt easier. Meanwhile, the Federal Reserve still has options. They're practicing quantitative tightening, or QT, which means they're letting bonds they purchased after the financial crisis and COVID mature off of their balance sheets. If they shift to a more neutral stance and start rolling over maturing bonds into new bonds, they could help push down rates even further because they'd be reinvesting into new government bonds. And if the economy does slow, they can still cut interest rates to help stimulate growth. So what's the bottom line? If there's going to be an economic slowdown, the administration would rather have it happen now than later, giving them time to recover before the next election cycle begins. That could be why we're seeing these aggressive moves right out of the gate. In the near term, the market could recover a bit due to the speed of the recent decline, but I think that this year is going to be more volatile than we've seen in a while. Does this mean that 2025 will be a throwaway for the market? I don't think so. Volatility doesn't necessarily mean a negative year. We'll just need to have a little bit more patience to get through the bumps this year. Where does this leave investors? First, don't panic. Market uncertainty is nothing new. Stay diversified. Different industries respond differently to tariffs, so spreading investments can help manage risk. So check your 401ks. Think long term. The S&P 500 has historically weathered many pullbacks and has still achieved strong gains. Avoid emotional reactions. Headlines can be scary, but staying the course has historically been the best approach. Finally, if you ever find yourself losing sleep at night because of your investments, maybe it's time to talk to your advisor about taking another look at your risk tolerance. We'll be watching this closely, but for now, the key takeaway is markets adjust, businesses adapt, and the long-term focused portfolios that stay the course tend to fare better in the long run. If you have any questions at all about how this evolving trade environment could impact your portfolio, let's talk. I hope you've enjoyed this tariff series and found it beneficial to you in some way. Please check out our website at Paragon-Wealth.com or our YouTube channel for more content. Give us a call at 215-348-3176 or email us at info@Paragon-Wealth.com. We'll see you next time.